Alright, so here we are. We are in Chapter 2, Question 5A. So I would encourage you to pull out your workbook as it has additional information. In order to get started on 5A, we need to walk through the individual transactions and apply some of the knowledge we went over and reviewed in this past week's live sessions or the ones upcoming later this week. First item being is a situation where this company, Dry Cleanest, and owned by Raya Kapoor, has 8 transactions. First of all, we want to do some analysis, and then we'll go to a worksheet where we will post those transactions and determine an updated asset and liability and owner's equity balance. So the first item is she borrowed $10,000 from the bank. Because you're borrowing money from the bank, you are gaining cash. You're increasing cash by $10,000. And you're increasing the liability because you borrowed money from the bank. Okay. So therefore you will owe money to the bank at a later time. Item number 2 is you purchase machinery for $7,300 in cash. So what you're using is $7,300. But as we talked about in our class, we are trading one asset for another. So we actually added another asset, being the machinery. It's considered an asset because it's a longer period of life. Third transaction is you bill clients $2,950 for completed services, which is due in 30 days. In this case, it's considered an account receivable because the client will pay it back at a later time. Accounts receivable is considered an asset because it's something the company owns, even though the customer has not paid yet. And in this case, it's a revenue recorded when the services are completed. So our owner's equity will result in an increase of $2,950. In this case, you performed services on account. Item number 4 is we paid $130 cash for regular maintenance on the machines. Again, we're using cash, so take out $130. And maintenance is a maintenance expense. Expenses decrease owner's equity. And that's because we paid the maintenance expenses. Item number 5 is we collected $1,300 from clients who owed us money. So we have now $1,300 more in cash, actual and asset that went up. But they owed us money, which means it was on our balance sheet as an accounts receivable. If they've paid off that accounts receivable, it's actually a reduction in the AR balance. So our assets go up in cash and down in accounts receivable. Item number 6, we paid $3,000 in advance for 4 months' rent. We're using cash, so therefore it's a reduction in our assets. But because we're paying in advance for 4 months of rent, it is for future rent expense. Anything that's not an expense today is considered a prepaid expense. Prepaid expenses are an asset until they're actually incurred as an expenditure for the organization. So in this case, again, apologize, we are increasing our assets, the asset being prepaid expense. Apologize for the spelling mistakes. Recorded $1,600 of cash sales for the month. Again, it's cash sales, so we actually have the money in our bank. And cash sales are revenues. Revenues increase owner's equity. And that's because we sold services for cash. Lastly, we paid $700 owed to a supplier. We are using cash, so our assets go down. And if we owed the supplier, that means it was on our balance sheet as an accounts payable. Therefore, we will owe him less, therefore we will reduce our liability. All right, so here we are. Try this 3 times now. Let's see if it records this time. So to carry on from the previous component, we now want to post the 8 transactions into the worksheet to determine the closing balances for each of the general ledger or each of the accounts, and then also to validate that assets continue to equal liabilities plus owner's equity. First transaction was the owner borrowed $10,000 from the bank. So we will add $10,000 to cash, and we will increase the bank loan for the same amount for transaction number 1. Next is we purchased machinery for $7,300 in cash, so we will reduce our cash accordingly because we paid it with cash, but we're adding to machinery for $7,300. And again, you'll notice I'm tracking the transactions by transaction number, which helps with any reconciliating issues that you might have at a later time. Item number 3 is we billed clients $29.50 for completed services which are due in 30 days. This is an accounts receivable because the clients did not pay us yet. They will pay us later on, but it is a revenue today. So they will owe us $29.50 for transaction number 3. Transaction number 4, we paid $130 in cash for regular maintenance on the machine. It's maintenance, it's considered an expense, so we will increase or debit our maintenance expense for the $130. Item number 5, or transaction number 5, we collected $1,300 from clients who owed us money. So transaction number 5 is we collected $1,300, which is an increase of cash. However, it's a decrease in receivables because now our customers owe us $1,300 less than they did before. Item number 6, we paid $3,000 in advance for 4 months of rent. $3,000, so it's a reduction of our cash, which is a credit. And it's for futures, so we are setting up a prepaid expense, which is a prepaid rent in this case, transaction 6 for $3,000. 7th transaction is reported $1,600 of cash sales for the month. We received cash of $1,600, so it's adding to our cash, increasing our cash, debiting our cash, and it's considered a sale for the current month, so we will credit or increase our revenue for transaction 7 in the amount of $1,600. Last transaction is we paid $700 owing to a supplier, so we will reduce or credit our cash by $700. We owed it to the supplier beforehand, so therefore we need to reduce or debit our accounts payable accordingly. We've now posted all 8 transactions in this question. Once you've done so, if you're doing this on the workbook again, you'll have to subtotal each one of the accounts, subtotal then your assets, subtotal your liabilities. Your owner's equity in this case are your capital, less any withdrawals, okay? And then add or subtract your net income or loss. So for example, if you had a positive capital like we do in this case, good, 4,680, plus we had revenue of 4,420 equals the 9,100. If there was a situation where Kapoor took money out, he would have had a balance on the left side, otherwise a debit balance or a decreased balance in the withdrawal account. Okay, so you would have taken the 4,680 plus the net income, less any amounts that he took out, would have been your closing owner's equity for that point in time. Okay, this will make more sense as we continue the chapter.